welcome to the special edition of the FII View with me, Tanveer Gill. My guest today on the show is a market veteran. Byron Veen is chairman of Blackstone Advisory Partners, where he acts as a senior advisor to both the firm and its clients in analyzing economic, social, and political trends to assess the direction of financial markets and thus help guide investment and strategic decisions. In 1995, Mr. Veen co-authored a book with George Soros on the legendary investor's life and philosophy, the famous Soros on Soros, Staying Ahead of the Curve. In 2006, Mr. Veen was in fact named by New York Magazine as one of the 16 most influential people on Wall Street. Every year, the market keenly watches out for Mr. Veen's 10 surprises for the year, where he lays out his predictions for the coming 12 months. Mr. Veen, thanks very much. I know this is your first interview through an Indian business channel, so we really appreciate you joining us today. Let me begin by asking you, on your note, in August, it spoke about you being worried about the second half of this calendar year. It raised caution in an otherwise buoyant market as the Fed spoke of tapering and stable U.S. economic recovery. While the markets year-to-date have done really well, the July to September quarter has been rather range-bound for the market. What do you think is on the market's mind at this juncture, and what do you think one can expect from the markets next?
Well, you would have expected that the market would have done well. Look at where we were on Labor Day. Labor Day is this holiday we have at the beginning of September where we give workers the first Monday in September off. At that point, we were worried about the United States sending missiles into Syria. We were worried about tapering. We were worried about Larry Summers becoming Fed chairman because he was a kind of wild card. We were worried about Iran's nuclear program. And at the bottom of the list, we were worried about the debt ceiling and the shutdown of the government. One by one, those have disappeared, except for the last one. Larry Summers decided not to run for Fed chairman. Ben Bernanke decided not to do the tapering. The Russians came up with a proposal to acquire the chemical weapons from Syria and ultimately, hopefully, destroy them. Hassan Rouhani of Iran said he was agreeable to discussing with world leaders some modification of the Iranian nuclear program. So the first four of those became more mild. The fifth one, though, became more severe, and that's what's influencing the market now. We're worried about the debt ceiling, and that's why the market has been range-bound. But there's a complacency among investors that somehow will solve this problem and will actually be able to meet our obligations when they become due. So the debt ceiling will be raised, and there's some indication that we're going to come up with a short-term solution for that very soon. So I think when the debt ceiling is raised, there's a good possibility there will be a strong rally in the U.S. I don't know how long that's going to last, though, because I'm concerned about third and fourth quarter earnings.
Well, Mr. Veen, you'd expected the market to fall more than 5%. I mean, you'd laid out a target of almost 1,300 on the S&P 500 at the start of this year. How have those projections now changed?
What I underestimated at the beginning of the year was that the fact that the market is driven by liquidity. We knew that the Fed had embarked on a program of $85 billion of bond purchases, both treasuries and mortgage backs, starting in January. That meant the Fed was going to put $1 trillion into the economy. In 2008, the Federal Reserve balance sheet was only $1 trillion. It was about $3 trillion when the year began, and if they continue to do that through year-end, which it looks like they're going to do, it'll be $4 trillion. Now, my view is that monetary policy is a very inefficient way to try to stimulate the economy. 3/4 of all that money goes into financial assets, boosting stock prices and keeping interest rates low. This market was driven to higher levels by the liquidity provided by the Fed. Only 1/4 of that money went into the real economy. That's why the real economy remained sluggish but the stock market has done very well. That's why I was wrong on my original projection.
Yeah, what is your expectation then from the market? Do you think that the S&P 500 will pretty much close the year around about the 1,700 mark?
Well, I think the market will end the year about where it is right now. I think it may rally when we come to an agreement on the debt ceiling, but I think disappointing earnings will keep the market from getting too far.
Right. It's a very crucial time for what's happening in the U.S. At this point. Do you think that a deal would be brokered at the 11th hour? And if so, what would be the market's reaction to that?
Yeah, I've always said that disaster is a way of not happening. But that's the consensus view. People are very complacent. They're just convinced that somehow we'll pull a rabbit out of a hat and figure out a way to come to an agreement so the debt ceiling will be raised. The big surprise would be if we actually bump up against it. We haven't defaulted on our debt in the United States since 1801, so it would be the first time in a couple hundred years. So my belief is that we'll come to an agreement, but if we don't, we could have a severe correction in the market.
Yeah, but what probability are you ascribing to the U.S. defaulting on its payments? And how will that translate into the market's reaction?
Well, I would give the possibility of a default only 1 out of 5, 20% probability. And if that happened, I think you could see the market fall 100 points on the Standard & Poor's 500.
Right, but doesn't that push back the whole timeline on the tapering decision? Wouldn't that have like a domino effect on, how data is interpreted over the next 6 months, and then thereby a decision on tapering taken?
Well, even with the $85 billion a month of monetary stimulus, the economy was only growing at 2%. I was arguing that the Fed shouldn't taper because the economy couldn't take it. And Ben Bernanke made that decision. I think he probably had a premonition that we might run into trouble on the debt ceiling and keeping the government running, and that may be one of the reasons he didn't taper. He warned of tapering in May, and the market had a pretty severe reaction, and interest rates rose quite sharply. So we knew that even indicating a possible change in Federal Reserve policy could have a deleterious effect on the market. My view is that we're not going to take that conditions are sufficiently tenuous right now that the earliest you'll see some tapering is in 2014.
Well, even if the deal is struck, what happens to the tapering plan and the recovery timeline? Now, it appears that things could be pushed back more than anticipated. In fact, the IMF has already revised global growth and growth for the U.S. In 2014 downwards. So doesn't that really shift the plan forward?
Well, look, I don't think the economy anywhere in the world is strong enough to withstand a withdrawal of stimulus. So we're still not growing fast enough. We're still only growing at 2%. So there's no reason for tapering in the United States. Europe is recovering, but it's only going to grow at about 0.5% next year. And I still think the ECB is going to have to be reasonably accommodative. The European balance sheet has come in a little bit as bank loans were paid back by various banks after the monetary easing that took place after Italy and Spain got into trouble. In China, the Chinese economy is growing at 7.5%. I was worried that wasn't a real number, but now I think it is. If you look at industrial production, exports, and electricity consumption, it really looks like China is growing at 7.5%. And I think that's because the banking system has been very generous in providing funds. So and we know what's going on in Japan. There's very vigorous monetary and fiscal stimulus in Japan. So government policy is a positive force in economies, in all the developed economies of the world, and in some of the emerging economies. and none of these economies are doing so well that stimulus can be withdrawn.
So then in your view, how do you see events playing out, economic and financial events playing out over the next 6 to 12 months?
Well, my belief is that the Fed will continue to be accommodative. They may do some tapering in 2014. I don't think they'll do any before that. But I don't think they'll do a lot because I think they recognize that monetary policy is central to the continuing feeble growth in the United States. So I expect that the U.S. will continue to grow at around the 2% level. I know there's some estimates out there closer to 3%, but I'm skeptical about those.
Looking back, do you think that the Fed got it wrong, that perhaps they jumped the gun in May when they hinted at tapering given economic recovery in the U.S.? And there could be a chance of more delay in that decision as now the Fed wants to wait and watch out for whether, the environment is more stable to actually initiate such a process.
I definitely think they were jumping the gun because interest rates rose sharply, housing was adversely affected, and the economy wasn't doing as well. We've gotten through now the third quarter, and growth isn't anywhere near 3%. Growth for the first half was below 2 overall. So I don't think we were growing fast enough for the Fed to withdraw the tapering.
Right, Mr. Veen, even though there is much talk about a U.S. recovery, there is a small segment of market opinion that talks about a possible recession in 2014 because we saw these sporadic recoveries in 2010, 2011. So there is a sense that, third time around, the U.S. economy could slip into recession, that this perhaps could be a dead cat bounce. What is the probability that you ascribe to the risk of a recession in the U.S. in 2014?
Well, I look at the Economic Cycle Research Institute, an independent economic organization, and they forecast slowdowns in the economy in 10, 11, and 12. But their figures show that the economy may be sluggish, but it won't go into recession. I would again put the odds of a recession in 2014 maybe 15%. I just don't see a recession developing. On the other hand, I don't see the economy being extraordinarily robust. I think we're more likely to stick toward the 2 to 2.5% growth rate.
Yeah, but 6 years into the crisis, are you disappointed at the state of the U.S. economy, or you think things have pretty much played out as per plan?
No, I think this is the way things are developing on the economy are pretty much in accordance with what I forecast. I was very good on the economy this year. The stock market did a whole lot better than I thought it would, and that was primarily because of the accommodative monetary policy.
Yeah, on the subject of tapering, Mr. Veen, of course, the other big concern is what that could do for global bond portfolios. Now, the IMF has clearly estimated that if the Fed does go ahead with tapering, scales back on its asset purchases, that would hint at rates going up, and even if rates were to rise by 1 percentage point, then that would mean estimated market losses on bond portfolios to the tune of $2.3 trillion. That's fairly sizable. Do you think the Fed is mindful of that at this point and would take a decision in accordance to the impact it can have on the markets?
Well, I believe the Fed is concerned about the amount of Treasury securities on its balance sheet. In 2008, when the total Fed balance sheet was $1 trillion, Treasury securities represented less than 10% of that. Today, the Fed balance sheet is about $3.4 trillion, and Treasury securities are about 25% of the balance sheet. So the Fed was talking about tapering because Treasury securities were such an important part of the balance sheet, and they were beginning to feel a little uneasy about the role that they were playing in Treasury auctions. That's why they talked about tapering. So you're right in suggesting that at some point in the future, the Fed is going to taper. But on the other hand, they're also aware that the stimulus that they're providing is keeping the economy going. and so they don't want to taper too much or too soon. So my guess is when they do start tapering, and as I said, I don't think that'll be until sometime in 2014, it'll be a modest amount. They may go from 85 to 65, maybe go down by 10 or $20 billion per month. They are also aware of what's going on around the world. When they had the simple talk of tapering, interest rates in the United States rose, and the emerging markets, both their currencies and the markets, suffered. So they don't want to create economic or financial turmoil elsewhere in the world, so they're going to be quite cognizant of that. So my guess is that the Fed is going to go slowly. What could modify that is if I'm wrong and the economy picks up considerable steam and starts growing near 3%. If that were the case, they would be more likely to taper early and taper in large amounts than I've been talking about. But I don't see that happening based on the data that I'm looking at right now.
Right, fair enough. Let's talk about Europe, Mr. Wien. Europe seems to have done rather well this year. In fact, very well year to date for those markets. With so much focus on the U.S. recovery, it's interesting to see most European indices. The Euro stocks are up almost 13 to 15% plus year to date. The entire Eurozone is still laboring through a fracture. What is this optimism suggesting to you?
Well, the optimism is suggesting that Europe is doing better. The economies are doing better. And that's true. I just came from Spain. Spain is very optimistic. I met with the Prime Minister of Spain in New York last week during the UN sessions, and he very clearly said Spain is back. The numbers coming out of Italy are better. Unemployment hasn't improved in those places, but economic activity, exports, the size of the deficit, they're better. France still is a problem, but things are improving somewhat there. Germany continues to be the economic driver of Europe. Overall, it looks like Europe is going to have modest growth. Continental Europe will grow 0.5% next year, but that's a lot better than the recession that they've been in for the last couple of years. The United Kingdom is doing well. So overall, I think the economies in Europe are doing better. But the markets have anticipated that. And as you point out, the markets have done well. And I think they reflect the improvement in economic conditions. One disappointment I have had is that Europe hasn't moved more toward a banking union, toward fiscal convergence, and the kinds of things that would sustain the European Union in a healthy state for a sustainable period of time. Europe is muddled through, but the structural changes that I wanted to see haven't yet happened.
Yeah, but stepping into 2014, would you be more bullish in Europe or the U.S.?
I think Europe is growing more slowly than the U.S., so it's in a more fragile situation. But Europe, the valuations in Europe are very attractive because nobody wanted to go near it for the last few years. So the U.S. market has done well. Europe has done well too, but not as well. So I think Europe is a little bit behind. But I think from an economic standpoint, the U.S. is clearly doing better than Europe and better than Japan.
You recently visited Asia a few months back. What is your sense on the outlook on emerging markets or even Asian markets, which have done well so far with all the money flow in the system? How do you see the story there in view of what is happening in the Western world?
Well, I've been disappointed at the severe slowdown throughout the emerging markets. I think you have to be very selective. Brazil is only growing at 2.5%. There's been a slowdown in India, and the rupee has collapsed. I'm positive on China because I think the growth is real there, and I'm positive on Mexico. And I think there's opportunity there. But I think that global portfolios should have representation in emerging markets, but investors should be very selective on which ones they pick. Ultimately, all of them will do well, and there will be more frontier markets like Turkey, Chile, Colombia that will enter the investment arena. But right now, I'd be very selective in China and Mexico are two that I like.
Why do you like China? I mean, you've spoken about how 7.5% growth in China seems real. The market is readjusting itself to a slower growth rate, but the broad expectation is that they're moving towards a better growth model, or so it seems. Is that the reason why you like China right now?
Well, I haven't seen the rebalancing of the economy. That would really make me enthusiastic about China. In the 5-year plan they introduced in October of 2010, they said they wanted to rebalance the economy and get the consumer back up to 45. Now we're 3 years into that 5-year plan, and they've made very limited progress. So, yes, China's growing at 7.5%, but they're using a lot of borrowing, a lot of leverage in order to do it. Bank loans and shadow bank loans as a percentage of GDP are well over 100% of the GDP. So it's taking a lot of stimulus in the banking system and the shadow banking system to keep China growing at 7.5%. But if they make progress toward rebalancing, if the consumer spends more, then I'd be more optimistic about China. But I still think Chinese stocks are attractive at these levels.
Well, since we have you with us, can't let you go without getting your view on India. What's the broad view on the India story as you see it?
Well, I'm keeping my eye on India because I've liked it. I was very enthusiastic about India at various points in the past. But until the currency stabilizes, until the economy starts growing again, until the government seems more stable and it doesn't seem as dysfunctional as the United States is, then I think I'm going to hold back on India. But I'm looking for an opportunity to make initial commitments.
But how would you compare India to other emerging markets at this juncture?
My view is that India is potentially very attractive, but I'm a little unsettled about it now. I think it's not as attractive at this point as the two emerging markets I do like, which are China and Mexico.
Yeah, but what is your view on the Indian market?
I'm neutral on India right now.
And when do you see that happening? When do you see India coming on your radar as an attractive investment option?
Sometime next year. I think after the election. Or when the election outcome becomes clear.
Okay, fair enough. So 2014 is going to be a critical year for India. I also wanted to ask you before we let you go on your assumptions for the surprises you predicted for 2030. Now, you had expected gold to touch $1,900 per ounce and oil to fall below $70 per barrel. How do you see those calls now?
Well, I think gold had a very severe correction, which I didn't anticipate. But I think that a lot of the gold that was sold in Europe, and particularly in the United States, in the spring of this year, was bought by India and China. That gold was bought to be held. I think gold could have a big rally in 2014. As far as oil is concerned, I thought it would come down in price because demand for oil is down and production is up. But there's a fear factor in the price of oil caused by the turbulence and unsettled conditions in the Middle East. I think if that clears up, and there's no certainty it will clear up, the price of oil could go to lower levels. Right now, the unsettled conditions look like they're going to continue, so I think Brent will stay around 110. But I definitely think if the Middle East cooled down, Brent could come down $10.
Well, we leave it at that, Mr. Bean. Thanks very much for taking out the time and speaking with us. This is your first interview to an Indian Business Channel, so we really appreciate you sharing your views with us. With that, we come to the end of this edition of the FII View. Thanks very much for watching the show.